Welcome to our micro-learning channel. Financial ratios are like the vital signs of a business. Financial ratios are one of the simplest ways to understand how healthy a business really is. Think of them as the vital signs of a company. Just like a doctor checks pulse, temperature, and blood pressure to assess a patient, ratios help us interpret the numbers from the balance sheet, income statement, and cash flow statement in a meaningful way. Instead of looking at raw figures alone, ratios turn those figures into clues about performance, stability, and risk. Together, they help us see not just what the business owns and owes, but also how well it earns cash and turns that activity into real financial strength. Next, we start with profitability ratios, which answer a simple question: is the company actually making money? Profitability ratios tell us whether the company is actually making money. The first one is gross profit margin, which shows how much money remains after production or direct costs are deducted from revenue. Next is net profit margin, often called the bottom line, because it shows how much true profit is left after all expenses, including taxes and rent, are paid. Return on equity, or ROE, goes one step further by asking how efficiently the company uses shareholders' money to generate profit. Now we move to liquidity ratios, which are about short-term survival. Liquidity ratios show whether a company can pay its short-term bills on time. The current ratio compares current assets with current liabilities, and a result above one usually means the business has more short-term resources than short-term debts. The quick ratio, also called the acid test, is stricter because it removes inventory from current assets. That matters because inventory may not be easy to convert into cash quickly if the company suddenly needs to pay suppliers or lenders. After liquidity, the presentation shifts to solvency, which looks at long-term financial risk. Here, the debt-to-equity ratio and interest coverage ratio show how much the company relies on borrowed money and whether operating income is strong enough to handle interest payments. In other words, this slide helps us judge whether the business is comfortably financed or carrying too much leverage. The next topic is efficiency, or how well the company manages its assets. Inventory turnover tells us how quickly products move through the business, while accounts receivable turnover shows how fast cash is collected from customers. The circular graphic reinforces the idea that efficient operations create a smoother cash flow cycle and reduce waste. Now we turn to valuation ratios, which help answer whether a stock is cheap or expensive. Price to earnings and price to book connect the market price to profits and assets, giving investors a way to compare what they pay with what they receive. The chart also shows how tech and AI era valuations can run much higher than historical norms, which raises expectations for future growth. Finally, this slide brings everything together with a few golden rules. Ratios only make sense when you compare similar companies, watch trends over time, and avoid relying on a single number in isolation. Financial ratios are powerful because they simplify complex financial statements into practical signals. When you understand profitability, liquidity, solvency, efficiency, and valuation, you can evaluate a business much more confidently. But the real skill is not just calculating ratios, it is interpreting them in context. The message is clear: context matters, and the best analysis combines financial ratios with industry knowledge, news, and future outlooks. Thanks for microlearning with us.